In 2020, one of Europe's largest fintech companies collapsed almost overnight. Wirecard was valued at more than 20 billion euros. It was listed on Germany's most prestigious stock index, the DAX. Major banks partnered with it across Europe and Asia. Regulators treated it as a symbol of Germany's financial technology sector. Investors believed it was Europe's answer to Silicon Valley payment giants. The company reported consistent profits and rapid global expansion. Behind the growth was an accounting scam built on revenues that largely did not exist. Financial statements reported rising transaction volumes and strong earnings. Balance sheets claimed billions of euros were safely held in overseas trustee accounts. Auditors were told the cash was secured in banks in the Philippines. On paper, the company appeared profitable, stable, and expanding globally. But when investigators demanded direct confirmation of the cash, the money could not be verified. Nearly 1.9 billion euros was missing. Within days, the financial structure collapsed and confidence disappeared. This was Wirecard, a modern accounting scam that exposed failures across auditors, regulators, and financial markets. Wirecard was founded in Germany in 1999 during the early expansion of internet commerce. The company initially focused on processing payments for online businesses. Many early clients operated in sectors that traditional banks avoided. This included online gaming, digital services, and emerging e-commerce platforms. The payment processing niche allowed Wirecard to grow rapidly in the early 2000s. By handling complex digital transactions, the company positioned itself inside the infrastructure of internet payments. In 2005, Wirecard acquired a small German bank. This acquisition allowed the company to issue its own payment cards and operate under banking licenses. The combined structure turned Wirecard into both a technology company and a regulated financial institution. The company promoted itself as a global payment platform for digital commerce. Throughout the late 2000s, online payments expanded rapidly across Europe and Asia. Wirecard presented itself as a gateway connecting merchants to global card networks. The firm claimed to process payments across dozens of countries. International expansion became a central part of its strategy. Wirecard announced partnerships with businesses in Asia, the Middle East, and Eastern Europe. The company reported steadily rising revenues each year. Its financial statements suggested strong transaction growth across global markets. Investors viewed the company as a leading European fintech innovator. Germany historically lacked large technology companies compared to the United States. Wirecard appeared to fill that gap in the financial technology sector. By the early 2010s, the company had built a narrative of rapid digital transformation. The firm emphasized mobile payments, digital wallets, and cross-border processing. These themes aligned with broader trends in financial technology. Institutional investors increasingly added Wirecard to technology and fintech portfolios. Market analysts highlighted the company's reported profit margins. Revenue growth appeared stronger than many traditional banks. The company expanded offices across Europe and Asia. Executives emphasized global scale in public presentations. Wirecard promoted itself as a platform rather than a simple payment processor. The narrative attracted large international investors. Financial media frequently described Wirecard as a rising European technology champion. By 2017, the company's valuation had increased dramatically. Its stock price reflected expectations of continued digital payment growth. The market increasingly treated Wirecard as a major fintech leader. In September 2018, Wirecard achieved a symbolic milestone. The company entered Germany's DAX index. The DAX tracks the largest publicly listed companies in Germany. Wirecard replaced Commerzbank in the index. This change reflected the shift from traditional banking to financial technology. Index inclusion significantly increased institutional investment in the company. Many index funds automatically purchased Wirecard shares. Global investors now treated the company as a core part of Germany's financial system. The promotion reinforced confidence in the company's reported financial strength. Few questioned the underlying mechanics of its revenue model. Market credibility expanded faster than transparency. Index inclusion reinforced investor trust. Wirecard's business model centered on processing digital payments for merchants. When a customer paid online with a credit card, the transaction moved through multiple intermediaries. Payment processors handled authorization, settlement, and currency conversion. Wirecard positioned itself inside this transaction chain. The company claimed to connect merchants to global card networks such as Visa and MasterCard. This infrastructure role allowed the firm to report large payment volumes. However, many of Wirecard's transactions occurred in regions where it did not hold local payment licenses. In those markets, the company relied on third-party acquiring partners. These partners were external payment processors located in countries across Asia and the Middle East. Wirecard described these partners as third-party acquirers. The structure allowed the company to expand quickly into new markets. Revenue from these partners was reported as part of Wirecard's consolidated financial results. The partners collected payments locally and routed transaction data to Wirecard's platform. Wirecard then reported a share of those transaction fees as its own revenue. This model created a large layer of outsourced payment activity. Large portions of the company's profits were attributed to these external partners. The arrangement made the company appear globally diversified. However, the financial structure became increasingly difficult for outsiders to analyze. Most investors focused on the overall growth figures. Few examined the detailed mechanics of the partner network. Analysts relied heavily on company disclosures. Wirecard reported that a large share of its profits came from this third-party acquiring model. The company described these revenues as high-margin international operations. By the mid-2010s, the majority of reported profits came from these outsourced processing arrangements. The company claimed these partners operated in fast-growing markets. Executives emphasized Asia and the Middle East as key expansion regions. However, the structure created a separation between reported revenue and directly controlled operations. Wirecard did not own or manage the infrastructure of many partner companies. Instead, it relied on financial reporting and documentation from those partners. Auditors often depended on documents provided through intermediaries. Verification of underlying transactions became more complicated. International payment flows crossed multiple jurisdictions. Local regulatory oversight varied significantly across countries. Complexity increased as more partners were added to the network. Investors generally accepted the explanation that global payment infrastructure was inherently complex. Rapid digital payment growth supported the company's narrative. Few institutions demanded detailed operational verification. Reported revenue continued to increase each year. Profit margins remained unusually high compared to many competitors. The outsourced acquiring model became central to Wirecard's reported financial success. However, the same structure also reduced transparency. Distance between operations and reporting created verification challenges. Complex international structures made financial validation difficult. Complexity reduces transparency. By the mid-2010s, Wirecard was expanding aggressively across international markets. Executives promoted the company as a global infrastructure provider for digital payments. The firm announced acquisitions in multiple regions, particularly across Asia. Several purchases involved small payment processors operating in emerging markets. These acquisitions were often presented as strategic gateways into fast-growing economies. Reported revenues from Asian operations increased rapidly in financial statements. Investors viewed the expansion as evidence of strong global demand for Wirecard's services. Company presentations emphasized mobile payments, and cross-border e-commerce. These sectors were expanding quickly during the 2010s. Wirecard positioned itself as a central platform connecting merchants and payment networks. Transaction volumes reported by the company continued to grow each year. Financial reports showed consistent revenue growth. Operating profits also appeared to increase steadily. Analysts often highlighted the company's high profit margins. Wirecard's leadership reinforced the narrative of technological leadership. Chief Executive Marcus Brown frequently described the firm as a global fintech champion. Public presentations emphasized innovation in digital payments and financial infrastructure. The company's valuation increased as investor confidence strengthened. By early 2017, Wirecard had become one of Europe's most valuable financial technology companies. Institutional investors increased their positions in the firm. Large asset managers included the company in technology and growth portfolios. Financial media regularly described Wirecard as Germany's most successful fintech company. The company reported processing billions of euros in transactions annually. International expansion appeared to justify the rising valuation. Wirecard's market capitalization continued to climb. By early 2018, the company was valued at more than 20 billion euros. This valuation reflected expectations of continued global growth. Executives frequently highlighted Asia as the company's fastest-growing region. Several subsidiaries were established across Singapore and other financial hubs. Regional partnerships were presented as drivers of payment volume. However, many of these operations remained difficult to independently verify. External investors relied heavily on financial disclosures provided by the company. Detailed operational transparency remained limited. Analysts rarely had direct visibility into the underlying partner networks. Despite this, investor enthusiasm continued to increase. Rapid expansion reinforced the perception of success. High reported growth encouraged further institutional investment. The market rewarded the company's narrative of global scale. Few investors demanded detailed verification of international revenue streams. Growth without clarity increases risk. By 2015, internal concerns about Wirecard's financial reporting began to surface. Some employees questioned how certain revenues were recorded in overseas subsidiaries. Accounting documentation related to partner companies appeared difficult to verify. These concerns gradually reached external journalists and analysts. In 2015, reporters from the Financial Times began investigating the company's operations. Their reporting focused on Wirecard's Asian subsidiaries. Documents reviewed by journalists suggested irregular accounting practices. Some transactions appeared to be artificially inflated. Internal emails raised questions about how revenues were being recorded. Whistleblowers alleged that certain profits were created through accounting adjustments. These allegations challenged the credibility of the company's reported growth. The Financial Times published a series of investigative reports between 2015 and 2019. The articles described concerns about fabricated revenue in Asian operations. Specific subsidiaries in Singapore became central to the investigation. Journalists reported that accounting entries were sometimes backdated. Some financial documents appeared to be altered after transactions occurred. The reports triggered market volatility in Wirecard's stock price. Company executives strongly rejected the allegations. Wirecard accused critics of spreading false information. The firm argued that its accounting practices complied with international standards. Management insisted that the allegations were part of a coordinated attack by short sellers. Short sellers profit when a company's share price falls. Wirecard suggested that market speculators were attempting to manipulate the stock. The company filed legal complaints against journalists and critics. Executives maintained that the business remained fundamentally sound. Despite the controversy, the company continued reporting strong revenue growth. Many investors remained supportive of the firm. The company's narrative of global expansion continued to dominate market perception. However, investigative reporting continued to uncover inconsistencies. Additional whistleblower claims emerged inside several Asian subsidiaries. These claims focused on the structure of third-party acquiring partners. Some partner companies appeared to have limited operational presence. Journalists questioned whether the reported payment volumes were accurate. The allegations increased pressure on auditors and regulators. Public scrutiny intensified between 2018 and 2019. Wirecard's management continued to defend the integrity of its accounts. The firm denied that any significant fraud existed. Market reactions remained divided between skepticism and continued investor support. Transparency efforts by journalists exposed structural weaknesses in the company's reporting. Independent verification became increasingly important. Investigative scrutiny can destabilize opaque financial systems. Transparency threatens unstable numbers. The allegations against Wirecard attracted attention from German financial authorities. The primary regulator responsible for market oversight was the Federal Financial Supervisory Authority. The regulator is commonly known as BaFin. BaFin supervises banks, financial markets, and listed companies in Germany. As scrutiny around Wirecard increased, regulators faced pressure to respond. However, the early regulatory response did not focus primarily on the company itself. Instead, attention turned toward market participants criticizing Wirecard. Authorities argued that negative reports might be influencing the company's share price. Short sellers became a central focus of regulatory investigation. Short selling involves betting that a company's stock will decline in value. Some regulators suspected that investors were coordinating to push the stock lower. In early 2019, BaFin took an unusual step. The regulator temporarily banned short selling of Wirecard shares. The restriction applied across German markets. This was the first time such a ban had been applied to a single company in Germany. The measure was justified as an attempt to stabilize market confidence. At the same time, German prosecutors opened investigations related to market manipulation. These investigations initially targeted journalists and market critics. Reporters from the Financial Times were among those examined by authorities. This regulatory focus created controversy within international financial markets. Some observers argued that regulators were defending the company rather than investigating it. Wirecard executives welcomed the regulatory intervention. Management argued that the company had been the target of unfair speculation. The firm repeated its claim that short sellers were attempting to damage the company. Investors interpreted the regulatory response as institutional support. Many market participants concluded that regulators had validated the company's position. The share price stabilized following the short-selling ban. Confidence in the company partially recovered. Institutional investors continued holding Wirecard shares. The regulatory intervention reinforced the company's credibility. Few large investors questioned the underlying financial statements. Public attention shifted away from the original allegations. Regulatory protection can influence investor perception. When authorities defend a company, markets often interpret the action as reassurance. However, regulatory focus on market critics can delay investigation of underlying problems. The financial structure of the company remained largely unchanged. Questions raised by journalists remained unresolved. Auditors continued reviewing the company's financial statements. The regulatory environment temporarily reduced external pressure. Wirecard continued operating as one of Europe's largest fintech firms. The firm remained a member of Germany's DAX index. Institutional trust remained largely intact. Oversight mechanisms can sometimes focus on symptoms rather than causes. Oversight can misidentify risk. By 2019, pressure to verify Wirecard's financial statements increased significantly. Investors demanded independent verification of the company's reported revenues. In response, Wirecard commissioned a special audit. The audit was assigned to the global consulting firm KPMG. KPMG was tasked with reviewing allegations related to accounting irregularities. The investigation focused on operations in Asia and the third-party acquiring business. These areas generated a large portion of Wirecard's reported profits. Auditors requested documentation supporting transactions recorded in financial statements. The process required verification of contracts, bank balances, and payment flows. Wirecard provided internal documents and transaction records. However, auditors encountered difficulty confirming some of the information. Certain partner companies did not provide complete documentation. In several cases, supporting contracts could not be independently verified. Auditors also requested direct confirmation of funds held in trustee accounts. These accounts were reported to contain large cash balances. The balances were allegedly held in banks on behalf of Wirecard's subsidiaries. The trustee structure added another layer between the company and the banks. Auditors attempted to obtain confirmation directly from the financial institutions. However, some confirmations were provided through intermediaries rather than banks themselves. This process reduced the reliability of the verification. Auditors noted that key evidence supporting revenues was incomplete. Certain transaction records could not be fully reconciled. Some partner companies lacked clear operational histories. The audit process highlighted the complexity of Wirecard's international structure. Financial flows crossed multiple jurisdictions. Verification required cooperation from entities outside Germany. The investigation continued through late 2019 and early 2020. During this period, investor confidence remained fragile. Wirecard's management continued defending the accuracy of its accounts. Executives argued that the company's business model was misunderstood. They maintained that the third-party acquiring structure was legitimate. The company stated that all funds were properly secured. However, auditors still required direct confirmation of major cash balances. The verification of these balances became the central issue of the investigation. Without reliable confirmation, the reported cash could not be validated. KPMG eventually published its special audit report in April 2020. The report stated that auditors could not verify significant portions of revenue. It also noted limitations in access to certain documents. The report stopped short of declaring fraud. However, it confirmed that key financial claims remained unproven. The audit increased pressure on Wirecard to provide clear evidence of its cash holdings. Financial reporting ultimately depends on verifiable evidence. Numbers must eventually reconcile. In June 2020, the central question surrounding Wirecard focused on a specific cash balance. The company reported holding 1.9 billion euros in trustee accounts. These funds represented a significant portion of the company's reported cash reserves. According to Wirecard's financial statements, the money was held in banks in the Philippines. The funds were described as being managed by external trustees. These trustees supposedly safeguarded the money on behalf of Wirecard's subsidiaries. Auditors requested direct confirmation from the banks holding the funds. The request was part of the routine audit process for the company's 2019 financial statements. Wirecard initially stated that the confirmations had been obtained. Documents appeared to show verification from the banks. However, auditors decided to verify the confirmations independently. Direct communication was initiated with the Philippine banks involved. The banks included Bank of the Philippine Islands and BDO Unibank. Both institutions were contacted to confirm the existence of the trustee accounts. The response from the banks created immediate concern. Both banks stated that the documents presented by Wirecard were not authentic. They reported that the confirmations were false. The banks also stated that the trustee accounts did not exist. This meant that the reported 1.9 billion euros could not be located. The information reached Wirecard's auditors during the final stages of the audit. Without verification, the cash balance could not be confirmed. On June 18, 2020, Wirecard issued a public statement. The company acknowledged that 1.9 billion euros was missing. Executives stated that the funds likely never existed. This admission fundamentally altered the company's financial position. A large portion of the reported balance sheet disappeared instantly. Investors reacted immediately to the disclosure. Wirecard's share price began falling sharply. Financial markets recognized the implications of the missing funds. The company's credibility collapsed within hours. Auditors withdrew their approval of the financial statements. Without confirmed cash reserves, the company's financial structure became unstable. Creditors began reassessing their exposure to the firm. Banks and lenders questioned the company's solvency. The missing funds represented roughly a quarter of the company's total assets. The discovery triggered a rapid loss of confidence. Financial institutions began limiting their relationships with the company. Regulators and prosecutors initiated formal investigations. What had previously been allegations now became confirmed financial failure. The reported cash balance had formed a central pillar of Wirecard's accounts. Once that pillar disappeared, the entire structure collapsed. Cash that cannot be verified does not exist. After the $1.9 billion were missing disclosed, the stability of Wirecard deteriorated rapidly. The admission created immediate pressure from investors and creditors. Financial institutions began reviewing their exposure to the company. The company's share price declined sharply within hours of the announcement. Market confidence, which had supported the company for years, began to evaporate. Investors recognized that a large portion of the balance sheet could not be verified. Without confirmed cash reserves, the company faced severe liquidity concerns. Credit providers reconsidered existing lending arrangements. Several banks withdrew financial support. The company's access to funding began to collapse. On June 18, 2020, the company publicly acknowledged the missing funds. Executives stated that the trustee balances were likely fictitious. This statement marked a turning point in the company's credibility. 2 days later, pressure intensified from lenders and regulators. Credit lines were frozen as banks reassessed risk exposure. Without financing, operational stability became uncertain. On June 19, 2020, Marcus Braun resigned as chief executive officer. Braun had led the company for nearly 2 decades. His resignation reflected the severity of the crisis. Shortly afterward, German prosecutors opened criminal investigations. Investigators searched company offices and collected financial documents. Regulators also began reviewing their earlier oversight decisions. The company's stock price continued falling sharply. Within days, billions of euros in market value disappeared. The DAX index faced the prospect of removing the company. Index membership had once symbolized financial credibility. Now it highlighted the scale of the collapse. Investors rapidly exited their positions. Institutional portfolios began removing Wirecard shares. Confidence across financial markets deteriorated quickly. On June 25, 2020, Wirecard filed for insolvency in a German court. The filing marked the first time a member of the DAX index had collapsed through insolvency. Thousands of employees faced uncertainty about the company's future. Payment services dependent on Wirecard infrastructure were disrupted. Corporate partners began terminating contracts. Customers and merchants moved payment processing to alternative providers. The financial structure that supported the company had unraveled within a week. A business once valued above 20 billion euros had effectively collapsed. The speed of the collapse surprised many investors. However, the missing cash had removed the foundation of the company's accounts. When the core financial claim disappears, institutional trust collapses immediately. Confidence evaporates instantly. Following the collapse of Wirecard in June 2020, criminal investigations began across multiple jurisdictions. German prosecutors opened formal cases examining potential accounting fraud and market manipulation. The investigations focused on senior executives responsible for financial reporting. Chief Executive Marcus Braun became the central figure in the investigation. Braun had led Wirecard for nearly 2 decades. Under his leadership, the company had transformed from a small payment processor into a global fintech firm. However, prosecutors alleged that financial statements had been manipulated for years. Authorities argued that revenues and profits were intentionally overstated. The missing €1.9 billion became the central element of the investigation. Investigators examined whether executives knowingly reported non-existent funds. On June 22, 2020, Marcus Braun was arrested in Munich. German authorities charged him with suspected accounting fraud and market manipulation. Braun was later released on bail, but remained under ongoing investigation. The legal proceedings focused on whether company leadership had misled investors. Another key executive soon became central to the case. Jan Marsalek had served as Wirecard's chief operating officer. Marsalek oversaw many of the company's international operations. Investigators suspected that Marsalek had direct knowledge of the disputed financial accounts. Shortly after the scandal broke, Marsalek disappeared. Authorities believe he fled Germany in June 2020. Reports later suggested he traveled through Belarus before disappearing. International arrest warrants were issued for him. German authorities suspect that Marsalek played a central role in the financial misconduct. However, his location remains unknown. The disappearance complicated the criminal investigation. Prosecutors continued building cases against multiple former executives. Investigators analyzed internal emails, accounting records, and financial statements. Former employees were interviewed regarding the company's internal reporting practices. The case became one of the largest corporate fraud investigations in German history. Court proceedings began examining how the financial misstatements were constructed. Legal arguments focused on whether executives knowingly created false financial disclosures. The investigation also examined the role of auditors and trustees. Responsibility for verifying financial information became a central legal issue. The collapse exposed gaps in corporate governance and oversight. Criminal proceedings aimed to determine individual accountability. Financial fraud investigations often take years to resolve in complex cases. Legal systems move more slowly than financial markets. However, major financial collapses eventually produce legal consequences. Fraud leaves legal consequences. The collapse of Wirecard triggered a broad institutional response across Germany and Europe. Regulators faced criticism for failing to identify the fraud earlier. Public attention turned toward the effectiveness of financial oversight. Germany's financial regulator, BaFin, became a central focus of the debate. Investigations examined how warning signals had been handled. Lawmakers questioned whether the regulator had responded appropriately to early allegations. Parliamentary committees began reviewing the timeline of regulatory actions. The investigation examined decisions made between 2015 and 2020. Particular attention focused on the handling of Financial Times reporting. Critics argued that regulatory resources had been directed toward market critics rather than the company. The collapse prompted a broader review of Germany's financial supervision system. In 2021, the German government announced reforms to strengthen oversight. New rules expanded investigatory powers for financial regulators. BaFin received authority to conduct deeper forensic examinations of listed companies. The reform aimed to prevent similar failures in the future. Supervisory procedures were redesigned to increase independence and transparency. Auditing oversight also came under review. The role of external auditors became a central point of discussion. For more than a decade, Wirecard's accounts had been audited by the same firm. Questions emerged regarding how key financial claims had remained unverified. Germany's Auditor Oversight Authority began examining the auditing process. Regulators reviewed the procedures used to confirm bank balances and partner revenues. The case revealed weaknesses in international verification processes. Financial reporting had relied heavily on documents provided through intermediaries. In response, regulators proposed stricter requirements for verifying overseas assets. Corporate governance reforms were also introduced. Boards of directors faced stronger obligations to supervise financial reporting. Risk committees were expected to increase scrutiny of complex business structures. Large listed companies were encouraged to improve internal compliance systems. European policymakers also reviewed cross-border regulatory cooperation. The Wirecard collapse highlighted challenges in supervising global financial technology firms. Payment companies operating across multiple jurisdictions require coordinated oversight. Regulatory frameworks began adapting to the growth of digital financial infrastructure. The case influenced discussions across European financial institutions. Reform efforts aimed to restore confidence in Germany's financial markets. Institutional credibility depends on effective verification and oversight. Regulatory systems evolve after major failures. Reform follows failure. The Wirecard collapse revealed structural weaknesses in modern financial reporting. The company operated within a complex network of international payment flows. This complexity made independent verification more difficult. Large portions of reported revenue depended on third-party acquiring partners. These partners operated outside the direct control of the parent company. Financial statements relied heavily on documentation provided through intermediaries. Auditors were required to trust confirmations routed through external entities. The structure reduced the ability to directly verify transactions. International payment networks can span dozens of jurisdictions. Each jurisdiction introduces additional layers of legal and regulatory separation. Verification becomes slower and more complicated across borders. Wirecard used this complexity as part of its reported business model. Revenue from partner processors became the largest source of reported profits. However, the operational activity behind those revenues remained difficult to confirm. Investors largely accepted the narrative of rapid fintech expansion. The company's inclusion in Germany's DAX index reinforced institutional confidence. Index membership signaled stability to global investors. Few market participants questioned the underlying financial structure. Auditors relied on documentation that later proved unreliable. Regulators initially focused attention on market critics rather than operational risks. This sequence delayed deeper scrutiny of the company's financial reporting. The missing $1.9 billion ultimately exposed the weakness of the verification process. Once the cash could not be confirmed, the entire balance sheet lost credibility. The collapse occurred within days because trust disappeared instantly. Financial systems depend heavily on verified information. When verification fails, confidence can collapse rapidly. Modern accounting fraud often relies on structural opacity. Complex business models can obscure the origin of revenues. International outsourcing can separate financial reporting from operational reality. Intermediaries can introduce additional uncertainty into verification processes. Auditors must depend on documents provided through multiple channels. Regulators must evaluate companies operating across global markets. Investors must interpret financial statements built on complex structures. Each layer of complexity increases the importance of independent confirmation. The Wirecard case demonstrated how modern financial systems can be exploited. The fraud did not rely on a single falsified document. It depended on a structure that made verification difficult. Opaque revenue channels delayed detection. Auditor dependence on intermediaries reduced verification strength. Regulatory confidence delayed deeper investigation. Investor trust reinforced the company's market value. Institutional signals replaced direct verification. Eventually, the system demanded proof of the underlying assets. When the cash could not be verified, the structure collapsed. The lesson extends beyond a single company. Complexity can hide structural weaknesses for years. When complexity replaces clarity, verification becomes optional until collapse.